Okay, let's be real. The crypto markets have been an absolute whirlwind of chaos lately. We saw this massive drop that left a lot of people scratching their heads, wondering what in the world comes next. So today, we're going to dive deep into what some are calling this historic great cleansing and figure out what it all means for the future of Bitcoin and Ethereum. So let's get right to it. What was the real trigger for this huge market shakeout? Was it just one bad day, one single event that sent everything tumbling down? Well, it turns out the reality is a lot more complicated than that. What we were really looking at was a perfect storm of macroeconomic pressures all hitting at the exact same time. You had the threat of a US government shutdown, you had the Fed staying super tough on high interest rates, and you had the Treasury basically sucking liquidity out of the system. All of that created this massive squeeze on what we call risk assets, things like tech stocks and, of course, crypto. But, and this is a big but, those external pressures, that's only half the story. To really get a handle on just how severe this drop was, we've got to look inside the crypto market itself. This wasn't just a reaction to outside news, it was a really deep internal cleansing. And that brings us to the most important word for today, deleveraging. It sounds complicated, but in simple terms, it just means a massive amount of borrowed money getting forcibly flushed out of the system all at once. So just imagine a bunch of traders borrowing tons of cash to make huge bets. When the market suddenly turns against them, they get a call, a margin call, and are forced to sell everything to pay back those loans. That forced selling creates a domino effect, a cascade that leads to a super violent price crash. Now, here's the real kicker. According to some really deep market analysis, this wasn't just another deleveraging event. No, this was the biggest one in the entire history of crypto. The sheer amount of forced selling was just on another level. I mean, just look at this chart. It really puts it all into perspective, right? You see other huge shocks like the FTX collapse or that crazy COVID crash. And then you see this recent event. It just completely dwarfs them. And that explains the incredible speed and the severity of the drop we all just witnessed. Okay, so now let's pivot a little. We're going to shift from that big picture view to a really fascinating case study that tells us a lot about the strategic thinking around Bitcoin. And we're going to do that by looking at MicroStrategy. Their whole approach gives us this unique window into how the big players are thinking about this asset. First things first, you just have to appreciate the scale of what they're doing. MicroStrategy holds over 600,000 Bitcoin in their treasury. That makes them one of the largest single holders of Bitcoin on the entire planet. It's a staggering amount. So you'll often hear this phrase used to describe MicroStrategy, Bitcoin on beta. But what does that actually mean? Well, in short, it's their strategy for getting leveraged exposure to Bitcoin. This means they're using financial tools, sometimes even debt, to get more exposure than just buying it outright. The whole goal is to amplify their returns. So if Bitcoin's price goes up, their stock is designed to go up by even more. Okay, so this leads to a pretty obvious question, right? We often see MicroStrategy's stock trading at a premium, meaning its market value is higher than the Bitcoin it holds. So why on earth would an investor pay extra for their stock instead of just going out and buying Bitcoin directly? Well, the answer lies in this really fascinating piece of game theory, something called the sovereign put. Think about it like this. Imagine you're a country, a sovereign nation, and you want to buy a massive amount of Bitcoin. If you try to do that on the open market, buying hundreds of thousands of coins, sellers would disappear, and the price would go absolutely parabolic. You'd be chasing it higher and higher. But there's an alternative. You could just acquire MicroStrategy. In one clean, single transaction, you'd instantly own their entire treasury of over 600,000 BTC. It's this potential for a huge, efficient acquisition by a major player that creates that premium. All right, let's switch gears and talk about the other titan in this space, Ethereum. Now, the investment case for Ethereum is totally different from Bitcoin's, but it is no less compelling. If you think of Bitcoin as digital gold, a store of value, then Ethereum is something else entirely. It's like the foundational infrastructure for a whole new digital economy. And to really get why Ethereum is so important right now, you have to look at the explosive growth of stablecoins. This quote just nails it. Stablecoins are having their ChatGPT moment. It's the perfect analogy. Just like we saw with AI, we are seeing this crazy, rapid, mainstream adoption of stablecoins from everyday people to businesses to the biggest players on Wall Street. So how does all this stablecoin growth actually make ETH itself more valuable? Well, it's a pretty clear and logical chain reaction. First, stablecoin use is exploding. Step 2, the huge majority of these transactions are being settled on the Ethereum blockchain. So as the value being secured by these stablecoins grows into the trillions, well, step 3, the demand for network security goes through the roof. And that leads to the final crucial step. Wall Street and other big institutions will have to buy and stake ETH to secure the very foundation of their new stablecoin businesses. So what's the bottom line here? What could all this mean for ETH's price? Well, if you start valuing the Ethereum network like you would any other unique, high-growth asset that's securing trillions of dollars, some models suggest a potential value for ETH that could go north of $10,000 per token. Now, I know what you might be thinking. A $10,000 price tag is a huge number, and it naturally brings up the question of competition. I mean, what about all these other fast-growing blockchains like Solana and Avalanche? What's to stop everyone from just leaving Ethereum? And this is where Ethereum's big advantages, its protective moat, so to speak, really come into play. First, it just has the biggest network value. It's the most established, most trusted blockchain out there. Second, it's seen as the most compliant with US laws, which for Wall Street is absolutely critical. But the most important factor, the real non-negotiable, is security. If you're a bank securing billions of dollars in assets, you aren't going to compromise on security. You're going to go with the most robust, decentralized, and proven network. And right now, that's Ethereum. So after this brutal shakeout, where does all of this leave us? We've looked at the very distinct, very powerful cases for both Bitcoin and Ethereum. It really seems like the market is now in a rebuilding phase, but maybe this time it's happening on a much, much more solid foundation. Honestly, the best way to think about this whole deleveraging event is like a forest fire. Yeah, it's painful and destructive in the short term, but it's also a really necessary and healthy reset. It cleared out all the dead brush, all the excessive speculation and dangerous leverage that was building up in the system. And what that's done is it's left the market in a much more balanced and healthy state. So from a short-term technical view, the outlook is actually pretty constructive. With all of that forced selling pressure finally gone, some analysis is even suggesting a potential 20% upside for both Bitcoin and Ethereum right from where they are now. And all of this brings us to the ultimate question, doesn't it? Has this massive shakeout, this great cleansing, truly set the stage for a real, sustainable recovery? Are we actually watching the foundation being built for a stronger, more resilient, and maybe the next major bull run in the crypto market? Only time will tell.